Hi, this is Jim Nissen, and this is a quick term timing podcast available on YouTube 24/7 and updated with detailed charts several times during the stock market hours. Right now, I'm focused on a chart dated August 30th, 2016, and I will be putting up a screenshot that's much clearer. But right now, I will go over what my objectives are in this quick term timing service. My objective is to give traders, particularly day traders, a real-time measurement of the sentiment, bullish or bearish, in the stock market. I do this by measuring the activity in puts and calls on the Standard & Poor's 500 index trading on the CBOE. I am not affiliated with the CBOE, and the info I use comes from the CBOE.com website with a 15-minute delay. Now, this data is available to everyone at no cost. I record the number of puts and calls and calculate the dollars involved in the puts versus calls every half hour. I also measure the total value of all S&P calls versus the total value of all S&P puts every 1/2 hour. This changes as the market fluctuates up and down. Now, this data is all I use to create the charts I show at QuickTermTiming.com and at QuickTermTiming, the YouTube channel. As mentioned earlier, I use this data. The data is delayed 15 minutes, and that doesn't really matter, as you will see why. The indicators tend to lead the market by two hours or more. Now, I update the charts shown on YouTube as often as every hour when the market is volatile. The data is updated every half hour, but the charts reflect the last full 1 hour of data. Now, this is done because many times when a spread transaction is recorded, the puts may be recorded before the calls by a few moments, and this could lead to an erroneous data of puts versus calls. By combining the last full hour of data, we can lessen the effect of this reporting procedure. At any rate, this occurs very rarely, and then it is corrected before the 2-hour window of predictability occurs. More later on my next podcast.